Welcome everyone to today's compliance forum. My name is Jared Moyer. I am going to be the presenter, the person that answers the questions today for the most part as it relates to this compliance forum. My teammate Diane Dean, she's going to be moderating the program today. She's going to be asking the questions and she'll be answering the hard ones that I can't answer along the way today as well. So if you've got questions you want to have considered, use the Q&A button, send them on over to Diane. We'll see if they get shuffled to the top. The goal today is to answer as many of your questions as we can during the 1 hour time frame. Can't promise we'll get to them all, but we're gonna get to as many as we can. We've got some pre-submitted. We'll take some live and shuffle them all up, and hopefully you're walking away today with a bunch of value and information, plain English answers as it relates to lending compliance. I also have another teammate that's working behind the scenes, a couple of them actually. Kyla Kroger, she'll be working behind the chat today. She's taking care of your experience. So if you're having audio visual troubles or you want information about a product, a service we offer, she'll hook you up, or she'll take your information, pass it along to one of our teammates. We'll reach out and we'll see how we might be able to partner with each other and help you out as you face those compliance challenges. Also working behind the chat today is Amy Kudlachik. She'll be shuffling questions over to the Q&A. Try to get your questions into that Q&A box. The chat we want to reserve for your experience, if you will, audio visual technology issues. All right, with that, the goal today is questions from you and answers provided by us in plain English. Diane, I'm going to turn things over to you, and I'm going to shut off the slides till we get to the end of the program so we can just focus on you and I and the questions and answers at hand. So let me stop sharing, and we'll turn things over to you.
All right, we will start with TRID and the closing disclosure. Can general seller credits toward closing costs be listed in Section L, paid already by or on behalf of the borrower at closing, or should these seller credits be broken out in the seller paid at closing column? This prevents us from including them in the finance charge.
Well, I think the key part to this answer is actually the first part of the question. I think I heard you say general seller credits, right? So if we're talking about general seller credits not attributed to any one particular charge, then Section L is where we're going to be able to put them as a lump sum credit. If you have seller credits that are specific to a charge, okay, then those need to go on page 2 of the closing disclosure in the particular line that's associated with that lender credit and what it's going towards.
Okay, on to HMDA. Do you have any examples of how completed government monitoring information should look for specific individuals from various races and or ethnicities? For example, the columns and codes to check.
So I think the way I want to answer this is when you're interviewing an applicant and you're required to ask them about their demographic information, they get to pick and choose whatever they want. Now, if they're in person and they don't pick something, you have to do visual observation, but you only get to visually observe the main race and ethnicity categories. You don't get to go into any further detail than that. If they are filling it out and asking you questions, you can help them. You're not required to help them. Now, I want to go off on a tangent. There is a government book. I don't recommend it, but there's a government book out there that says if they're this, then they're that. I've never used it. I don't know of a financial institution out there that uses it. But if you want to go and go down that rabbit hole, I suppose you can. Otherwise, it's simply you ask them, they get to be whatever they want. If it's in person and they didn't provide, you visually observe, but only the main categories. And don't make it harder than it needs to be.
A lender provided a verbal counteroffer to an applicant, but the applicant chose not to move forward with the request. Unfortunately, the lender treated the application as withdrawn in error and did not provide an adverse action notice. For HMDA, do you recommend reporting as withdrawn or denied?
So the customer asked for something. We said no, but, and they said no, thank you. They didn't take us up on our counteroffer. Well, from a HMDA standpoint, that's a denied counteroffer, should be reported as a denial. And from an adverse action standpoint, we need to send them an adverse action notice, either a combined counteroffer denial or we go back and deny the original request. One way or another, they get a piece of paper under Reg B, and it should be reported as a denial for the Home Mortgage Disclosure Act.
Okay, we have a couple flood. If we have a loan request to purchase a property that is in a special flood hazard area, with the only improvements on the property being a storage building that is not permanently affixed to a foundation, can we still originate the loan without flood insurance? Or would we need to require the building be affixed?
So there's all kinds of what I'll call mobile or non-permanent storage sheds that you can put in your backyard that you can go buy at Home Depot or Lowe's or Menards or whatever. Those are not insurable. In fact, many of them likely have an insurable value less than the lowest deductible, so you can't get insurance anyway. But some of them go higher than that. So those would not have to be tied down at a fixed if they're truly mobile. There's a lot of storage containers out there that look like they could be, buildings, but they're not. They're mobile. You can bring a semi truck and trailer in and load them up and take them away. And no, the flood insurance wouldn't be required on those.
How about a mobile home? Can we make a loan secured by a mobile home located in a special flood hazard area that is not affixed?
So the mobile home's a little different. It can't double as a boat and float. It has to be tied down. So if somebody comes to you with a mobile home that's going to be placed in a 100-year floodplain, you can't make them the loan unless they tie it down first, go purchase the flood insurance, which they won't be able to purchase unless it's tied down, and then you can make the loan. Again, can't double as a boat and float.
We've talked a lot about 1071 lately. Will you provide a status update on the 1071 rule?
All right, so Section 1071. Let me start with Congress. Late last year, Congress put together a joint resolution to basically tell the CFPB their regulation wasn't written, wasn't up to par. And so the Senate voted on it, the House voted on it, it passed. In other words, they said, hey, your regulation's no good, go try again. But the only way that happens, it comes to fruition, is if the president signs off on it. Well, President Biden in mid-December vetoed that. That meant it went back to the House and the Senate, and it would have to pass with a 2/3 majority vote. It went to, I don't remember which one it went to. I think it was the Senate. It didn't pass. It didn't get the vote. So it's dead. So any hope of Congress right now with that joint resolution specifically coming to the rescue and getting us a new regulation, not a new law, but a new regulation to carry out 1071, that's kind of done and gone for the moment. The other thing that we have going on is the Supreme Court case. If you recall, there was a challenge in the state of Texas as well as the state of Kentucky. A stay was granted because it was turned over to the Supreme Court, and the Supreme Court is going to rule on whether or not the CFPB's funding mechanism is constitutional. They are not deciding whether or not 1071 by itself is something that should or shouldn't have happened. And so there's a lot of moving parts to this thing. Long story short, okay, the Supreme Court has until June to come to their conclusion on the CFPB's funding. Once that happens, we'll know a lot more what the runway looks like with respect to 1071. But I guess I want to leave you with this: the law is still the law. The law is not being challenged. Okay, that's the Dodd-Frank Act 2010. 1071 is going to happen. There could be some tweaks to the regulation, but for the most part, without that regulation rewrite based on that joint resolution, it's probably going to look a lot like it does today. May have some minor adjustments along the way, but that's kind of an update in a nutshell.
Okay, back to HMDA. For a loan to be reportable as a purchase for HMDA, does the dwelling being purchased need to be the collateral?
Okay, so when it comes to HMDA, it's collateral plus purpose. I first have to have a dwelling secured loan secured by a HMDA defined dwelling, and then we look to the purpose of the loan. So I could have a loan secured by my current dwelling to buy a new dwelling, and that's a purchase. What's the purpose of the loan proceeds once we have a defined HMDA dwelling that's going to be our collateral? Does not have to be secured by the loan being purchased to be a purchase.
Regulation B and the appraisal requirements. If we have a loan secured by first liens on multiple dwellings, is it exempt from the appraisal requirements? And if so, can I get in trouble from following them anyway?
Yeah, that was a clarification that kind of caught us off guard. I want to say 2020, 2021, the CFP put out some advisory. I don't know what they called them. They got lots of different ways they send out information, but they put out a publication that says, hey, we're clarifying if you have a loan secured by multiple dwellings and their first liens, then it wouldn't trigger the appraisal notice and free copy requirements. Now, can you over comply? Certainly, there's no harm in doing so, but technically it wouldn't be applicable in those situations.
For HMDA, should we report the number of units for a dwelling as is at the time of application, or what it will be at closing or would have been had the loan closed? For example, a 1 unit that will be turned into a duplex.
We're going to go with as is based on feedback from the CFPB. As is, so past tense. What was it before you made the loan, and then that gets changed after? Okay, so what is it when you make the loan, not after you make the loan?
Going back to TRID, do you have any advice or resources you could share regarding homeowners insurance estimates on the loan estimate?
Well, I think you need to have a method to your madness. And it could be you've done some research with a local insurance agent and you've got them to help you come up with this method. Maybe it's a calculator, a spreadsheet of sorts, but you can't just pluck numbers out of the sky, throw darts at the wall to come up with that information. It could be, in certain circumstances, you get the applicant to bring you or give you information. At the end of the day, TRID is based on the best information reasonably available at the time the disclosures are provided. Now, it comes with a caveat that you do your homework. Again, can't pull numbers out of the sky, throw darts at the wall. We have to reach out to third parties in certain circumstances, and that could be a phone call or based on past experiences.
Back to flood. When determining the replacement cost value for flood insurance policies, we try to use the value on the flood insurance policy, but sometimes need to resort to the replacement cost on a hazard insurance policy. This is typically much higher because it includes the foundation. I'm concerned about the inconsistencies between these two approaches and would like your thoughts.
So I understand at the end of that question the inconsistency there because we like to take it from the policy. Sometimes that raises red flags because agents are the ones that are identifying that. And it's based on systemic calculations that aren't always right or perfect in certain situations. So maybe it doesn't work in certain scenarios to use the policy, and we've got better information available. Sometimes we need to go to the hazard insurance policy, and the Q&As, the guidance that's out there suggests that those are just illustrative examples. There could be other methods for you to come up with the insurable value. Here's what it comes down to, and I'm going to go back to that guidance as well, those Q&As. Okay, whatever method you use, and you've got flexibility there, okay, can be relied upon so long as, and here's the kicker, it can be supported. In other words, you've got to tell a story and document it. If you can do so, then that should get you by an exam. Now, I want to go back to the inconsistency. I think you should try to be as consistent as possible, but I can't promise you that in every scenario you're going to be able to be consistent. Okay, different buildings, different areas, different, ages, uses of those structures, all of that, the materials, all of that matters when it comes to insurable value, right? So, I'd love to say, be as consistent as possible, but it's not always going to be possible. The bigger thing is your story, supporting how you came to your conclusion.
If a customer withdraws a trade request the day after application, do we still need to send out disclosures?
Now we throw a party. We don't have to send out disclosures at that point. If they deny before we get to day three, no, if they withdraw before we get to day three, we don't have to send them anything. But do remember, if it is or will be secured by a first lien on a 1 to 4, we will still have to provide the ECOA appraisal notice. But outside of that, we wouldn't have to do anything further as far as disclosures that are sent out.
Back to Hamda. We have a loan to transfer ownership of a residential property from entity A to entity B. A loan
Okay.
to entity A secured by the same property will be paid off, and a new note, deed of trust, and warranty deed in the name of entity B will all be executed at loan closing. Is this Hamda reportable? And if so, what should the purpose be?
Okay, so I think I caught all that or most of it. So fill in the blanks if I missed it. That's a lot of information. I'm going to go with yes. We've got a dwelling secured loan where the ownership is changing at the same time as the loan. Sounds to me like we have a purchase. So yes, it's HMDA reportable if it's a HMDA reportable financial institution, and then it would be a purchase if there's a title transfer at the time of the loan.
When we're using the detached structure exemption for flood, do we need to provide a flood notice for every Meyer event, even when we pull a new flood determination?
So if you have a Meyer event, I'm going to kind of turn this around a little bit. So if you encounter a making, increasing, renewing, extending, every Meyer event requires you to provide a new special flood hazard notice. There's no exception for that. The detached structure provision that allows you not to require insurance on all structures if certain criteria are present also has to be reevaluated with every Meyer event. So that Meyer event's a big deal. It triggers a new notice every time. You got to do a new determination every time. And if we're talking about the detached structure provision, it has to be reevaluated every time.
For TRID purposes, would adding a co-applicant require us to redisclose the loan estimate?
Short answer would be no. No.
Back to Hamda. If we have a bridge loan where the maturity goes beyond the 12 months by mistake, by just a few days, do we still report NA for total loan costs, as that was the intent, or report the total loan costs since this longer maturity technically makes this loan subject to the ability to repay requirements?
Okay, so this gets a little complicated if I took my notes correctly. HMDA borrows from Truth in Lending relative to data fields that are reported if you're a large filer as it relates to those points and fees and things like that, right? So if you intended to make a loan term of 12 months or less in order to circumvent ATR, that would get you out of having to report certain things for, I think it was total points and fees, right, Diane? That's the one we have at hand here.
Total loan costs.
Total loan costs for HMDA. So if we kept it 12 months or less, we wouldn't have to report that for HMDA because those rules work together. However, if we go beyond 12 months in ATR, that's also going to require us to report that field for HMDA because they work in tandem, if you will. So I know you didn't mean to based on kind of what the way the question was worded, but unfortunately, it's going to bring ATR to the table as well as a reporting number for HMDA and that total loan costs field.
And this next one is actually on government monitoring information under Regulation B, asking, is it required on a loan to purchase two vacant lots if the loan will be secured by the applicant's primary residence?
All right, I'm going to have some fun with this one. So let's talk HMDA first. We're going to use our primary dwelling to buy two vacant lots. Let's just say they're consumer purpose. So that's going to be consumer purpose, home equity. It's going to be subject to HMDA and we collect. Let's say I'm going to use my current home to buy two vacant lots for commercial purposes. Okay, well now it's dwelling secured, but it's business purpose. Now we have business purpose home equity. We're not going to collect because it's not subject to HMDA. It's also not, in that last scenario I gave you, going to be subject to traditional Reg B because it's not to purchase or refinance my primary dwelling. Now, you thought we'd stop there. We're going to go one further. Let's bring 1071 to the table. So if my current home is the collateral to buy two vacant lots and their consumer purpose, that means it's HMDA and it's not 1071 because 1071 is all about commercial purpose, right? But if I use my current home to buy these two vacant lots and it's for commercial purposes, well, since HMDA's out, 1071 is going to be in. This is looking down the road, and then you would collect demographic information under 1071, which is different than HMDA. And if you haven't been to those training sessions, you're going to need to get there sooner or later. We've got a lot of solutions out there on our menu. We've got a half-day webinar on that tomorrow. Our membership group that meets monthly is meeting on Friday, and there's some super cool things that happen if you're part of that membership group. You get access to all of the trainings at no extra cost. If you want to know more, reach out. I'd love to talk to you.
You do have a weird definition of fun, Jared Moyer. On our construction loans, then we're going back to TRID, we require the borrower to bring 20% of the cost to build to closing and pay that to the builder with the first draw. In the payoffs and payments table of the alternate CD, can we combine this with the other holdback amount, or should it be itemized separately? If itemized separately, how should we describe it?
We're going to go with itemized separately, and it could be down payment. I mean, you can come up there. There's no rule in TRID that says how you should itemize it, other than it should be separate and you should have a clear description. TRID gives you the flexibility to come up with a clear, I was going to say clear and conspicuous, but a clear or clarity when providing descriptions for things that are disclosed on the closing disclosure or the loan estimate for that matter.
For HMDA and online applications where demographic information is left blank and we never see the applicant face to face and they don't respond to our requests for additional information, should the demographic information section of the 1003 be left blank, or should we mark it, I do not wish to provide?
If they left it blank, you leave it blank. And so we're going to report did not wish to provide. If you go back and I'm sorry, I said that wrong. If they left it blank, you leave it blank and you report not provided by the applicant. If you put did not wish to provide, that is a response from the applicant. And that's not what you got. You got that they left it blank. And so that's what you report, that they did, they didn't provide the information, not that they chose not to provide it. Okay, hopefully I didn't mix that up too much there.
Back to Reg Z, when calculating the ability to repay, are we to consider the balloon payment of a 5-year arm in the debt to income calculation.
Okay, so if you're a small creditor, which means you have access to the balloon QM, then the balloon payment never has to be utilized in your ATR calculation for debt to income ratio and residual income. However, if you're not a small creditor, keep in mind that any balloon that happens within the 60 months that follows the month in which the first payment's due has to be utilized in your ATR calculation, so debt to income, residual income. However, if it's a high priced mortgage loan, HPML, then it doesn't matter when it occurs. You have to use the balloon no matter what. Again, those are all things we cover in our 2-hour ability to pay program if you want more information on that.
On a TRID loan, if an escrow holdback account has to be established due to incomplete repairs, how should the holdback funds set aside for the repairs and the escrow holdback admin fee charged by the title company be disclosed on a purchase and on a refinance? And they clarify that the holdback is required by them as the creditor.
All right, well, let's do the easy part first. If there's a fee being charged for administering the escrow account, if you're charging that fee, it goes in Section A. If you're requiring a third party to do the administration, it's going to go in Section B if you don't let them shop, Section C if you let them shop. So that should take care of the admin fee, regardless if it's a purchase or a refinance transaction. In a purchase transaction, we're going to go to page 3 of the closing disclosure, and we're going to go to section it'd be top left. Okay, is it K? Section K, right? Top left. I've got
Yes.
one here
Yeah.
somewhere.
Yeah.
Off the top of my head, I try to remember so much, and that one is eluding
Yep.
me for the moment.
No, that should be
K.
right.
Yeah, Section K. I've got a closing disclosure always handy. Anyway, Section K on the with the seller version where it says due from the borrower at closing, we're taking from the borrower there. So you're going to take and hold that money back rather than letting them have it at the closing table. You're giving it to them in L, but you're taking it right back in K, and you'll get it to them once the repairs are completed. If we're talking about a refinance transaction, you could certainly do it the same way. You can use the full primary disclosure. You just wouldn't have any seller information, so you still put it in K. But if you use the alternate form, it's just going to be in the payoff and payments table, which is simply a combination of a section K and L, but all in the same section.
For HMDA, if we refer to an existing deed of trust for a second loan, is this a second lien for HMDA, the appraisal disclosure, and HPML purposes?
It's going to be a first lien transaction.
And staying
You're in a
with
first position.
For small filers under HMDA, can we enter exempt or 1111 or whatever the applicable code is on data fields where we are not required to report when there is no co-applicant, or must we enter the no co-applicant code?
Well, let's start with the way the questions finishes up. If you enter no co-applicant, that's a response. And that's not what you have. You're a small filer. You're not supposed to be providing responses there. Now, you voluntarily can, but then you need to report it across the board. So the exempt or the 111, whatever you said it was, that's what should be reported if you're a small filer for those small filer fields. Say that 10 times fast, small filer fields.
On a TRID application where there will be a large tax credit from a seller at closing, can we list the credit for the property taxes on the loan estimate to reflect a more accurate amount for the estimated cash to close for the buyer, either as a seller credit or as an adjustment and another credit?
Logically, Diane, we've talked about this over and over, and we do a lot of training. We get this question quite often. Logically, it makes sense that you would do that because it would lower the amount of cash that your borrower would have to bring to the table. It makes everything look better, right? Unfortunately, the way TRID's written, it seemed to indicate that you can bring information related to something that would be paid or credited by the seller like that in the adjustments and other credits, and it doesn't meet the definition of a true seller credit. And so it doesn't go in the seller credit line either. And so it looks like on the loan estimate, we just need to leave that off and kind of have that side discussion with them. But when we get to the closing disclosure, if you've got a clear runway to do that, it goes in the adjustments and other credits section because it shows up on the 4 quadrants that are on page 3 of the closing disclosure. But the loan estimate, just the way it's worded, appears to be off limits. Now, that said, if you're doing it, I haven't seen a bank written up for it. And what would be the real harm there? That's not a polluting of the document, if you will, of information that shouldn't be there. It's just the way the rule's written doesn't appear that you can do it that way. So it'd be a ticky-tacky violation if you did.
This next one I divided up in a couple of parts. So the first part,
Okay.
in the case of someone being on a deed or mortgage document, but not on the note, what disclosures are triggered to the non-borrower?
Okay, so they're just on the deed or the mortgage, but they're not liable for the debt, if you will. So unless it's a rescindable transaction in which they would be required to get material disclosures like the rescission notice, the closing disclosure, as long as it's not a rescindable transaction, they're really not going to get anything from a disclosure standpoint. Now, again, if it is rescindable, they get material disclosures because it's subject to the right of rescission, and truth in lending says they got to get the rescission notice, the closing disclosure, et cetera, in order for the rescission period to start. So that as long as it's not rescindable, there's no required disclosures in that instance.
And the second part, do we need to get any kind of intent from them?
So there's no liability that's being voluntarily brought forward. Therefore, no intent to apply. I'm kind of trying to read between the lines here. No intent to apply because there's no liability. So shouldn't need to get anything there. Now, you might want to write the story out or something like that, or why it's structured the way it is, but make sure you're not saying that you tried to make so and so be liable, because you can't go there either. You don't want to get yourself into a fair lending snafu.
This one's on rescission. Does rescission apply on the permanent financing of a construction loan that was a remodel of the borrower's current primary residence?
Okay, so we want to be careful with the word construction here. Brand new construction from the ground up, there's going to be some exclusions for right of rescission. But where I have my existing residence and I take equity out in it to remodel it, rehab it, whatever, those are all going to be rescindable transactions. They're not excluded from right of rescission like a residential mortgage transaction, like brand new construction from the ground up would be in the Truth in Lending Act rule.
This one is on the Military Lending Act. Our
Okay.
lending policy states a credit report is valid for 12 months. If we rely on it for a covered borrower status check under the Military Lending Act, do we need to do a separate search on a new application that we would otherwise rely on the existing credit report for?
Okay, a couple things on this. Let's tackle the Military Lending Act first. The Military Lending Act use of the credit report as the cross check there, the credit report has to be fresh within 30 days of the application date. So this policy or procedure you have that says you can reuse a credit report for up to 12 months, it's not going to work for Military Lending Act if it's outside of 30 days old. So you've got a problem there. So you'd have to re-verify. I want to go a little further into this with the idea that you're using a credit report that was not pulled in connection with that particular purpose, meaning that particular loan. Unfortunately, the Fair Credit Reporting Act, relative to this particular section, is a bit old, and there's some gray area to it. But I want to talk about kind of the way things are situated today. If you go to the CFPB's website and you look at the consumer complaints, the number one complaint out there is about consumers' credit reports, use of whether or not the data is accurate. I mean, there's just a whole lot of ugly going on right now with consumer reports and the information contained within them, and a lot of it has to do with accuracy. Accuracy comes into play when you use a credit report, and so I would think you'd always want to have the most up-to-date information. Now, the number one pushback we get is, well, if we pull somebody's credit report, it dings them and their credit score goes down. My question to everyone every time this comes up is, when did you become the keeper of credit scores? You're a credit report, credit score user. You're part of the system. If you're not pulling a report showing that somebody's inquired, you're not helping the next financial institution down the road with the risk associated with credit in that particular applicant. You think you're doing them a favor because their credit score is not going down, but when in fact you're doing a disservice to the next prospective user of the credit report. Just like you want accurate information when you pull that next credit report on what's happened up until you pulled it, the same next user does as well. And so our recommendation is that you pull a new credit report each and every time, because it's for that particular purpose. If you want to go back and take a look at the exact wording in the regulation, again, there's still some gray area there, but this Military Lending Act is just one of many items that makes us go, this isn't a good idea. Credit freezes can be put on there. fraud alerts since the last time. And if you didn't pull a new one, you wouldn't see that. Just like scores go down, they can go up, and that can be more beneficial to the customer. ATR has to be the most recent information. Okay? So there's a lot of things that are leaning towards pull a new one every time. Now, I'm not saying you have to go change, but if you want to be in the best position, use a new one every time.
Back to flood. We recently pulled a flood determination that showed just the outskirts of our security property in a special flood hazard area, but not the home or any other buildings. What documentation do you recommend we keep in the file?
Okay, so when you do a flood determination, they're looking at the property, but they're looking at the property and where the buildings are at. So you might have a flood determination that comes back and states that there's a 100-year floodplain on the property, but the buildings on the property are not in the 100-year floodplain. If that's the case, then you don't have to provide a notice, you don't have to require insurance and all the other stuff that goes along with the mandatory purchase requirements. That said, if you've got a determination that says that there's a 100-year floodplain present, you better write out a story that explains, if the flood determination doesn't, that the buildings are not in the 100-year floodplain. It's common to see that, but we need a story. We don't want people just kind of making it up for themselves because the story is lacking in your loan files.
For HMDA reporting, what would be the correct way to report construction method for a mobile manufactured home that has been permanently affixed and has a purge title? Would it still be reported as manufactured, or would purging it mean it no longer meets HUD's code and we would report as site built? And then the second part, what about if the purged mobile home was built in 74?
Okay, let's start there. So there's a date. I don't know it off the top of my head, but it's 1976. There's a month, a day, and then something 1976. If the mobile home was built prior to that, it is not a dwelling ever. Okay. If it's built after that date and it's HUD approved, then it's a dwelling and it's a manufactured home. If it's built after that date but not HUD approved, it's still a dwelling but not a manufactured home. Did I get that right, Diane? I think I got it right.
Sounds good. Yep.
All right. Tell me there'll be easier questions.
I'm not making any promises.
Okay.
Under Regulation B, is a formal application required on consumer purpose loans secured by real property?
Okay, so real property is dirt. It doesn't necessarily have to include a dwelling. What Reg B states is if you have a loan that is going to be secured by my primary dwelling for purchase or refinance purposes, then I have to have a written application. Now, that responsibility rests with the lender, not necessarily the applicant. And so my yellow notebook here that I'm making notes on as Diane reads me questions, I could be jotting down the information that's necessary under Reg B, and this would suffice. Many of you have a nice formal application, and that works too. But those are the only scenarios where it absolutely has to be in writing. So it's not triggered by real property, rather a dwelling, purchase, or refinance.
This is on the rate set date. We have a loan in which we had a change of circumstance for points and lender credits being added, but the rate stayed the same from the initial lock-in date. Does the rate set date change with the points and lender credits, or since the rate did not change, do we keep the original lock date?
Okay, so there's actually quite a few things going on with this. So I want to start with the change circumstance. That's a TRID thing. And so the change circumstance that was alluded to was because of the points and fees and or lender credit changing. And if those things are changing outside of the regulatory tolerances, then if you want to reset the tolerance baseline under TRID, then you have to issue a new disclosure within 3 days of learning of that information. Then we jump to discussion about the rate lock and the date the rate was set. My understanding from the question, what I wrote down was that the rate didn't change. The rate was in fact locked prior to the change circumstance, and that even though the points and fees and or lender credit was going to change, the rate lock was going to remain the same. Is that what I gathered, Diane?
Correct.
Okay, so when we issue this new TRID disclosure, updating the points and fees and lender credit, we're going to leave the rate lock information the same because that rate lock agreement hasn't changed. Okay, so that information stays the same. Now, I think the question ended with, well, what about the rate set date? Well, since the rate lock isn't changing, the rate set date doesn't change and that rate set date is important for a lot of different things, not just TRID and the rate lock section, but for ability to repay and the qualified mortgage rate spread thresholds. Off the top of my head, high price mortgage loan uses the date the rate was set. So does high cost mortgage loans. And HMDA uses it. Trying to think of all this stuff off the top of my head. Did I leave something out?
Not that I can think of.
Okay, so yeah, HMDA, ATR, high cost, high priced, QM, I guess that's part of ATR. And then just TRID is their line there as well as the question alluded to. So lots going on there. But if the rate lock didn't change, then none of that stuff needs to be updated from a TRID standpoint, just the change circumstance information. And then anything else that has been that is more up to date than what it was the last time your disclosure was presented.
For HMDA, if we do not have an address until after closing, should we report NA or update the address once available?
So there is a thing in HMDA that says that if all of that ends up being true, like what Diane just said, that NA can be the ultimate response when it comes to that. So yeah, that is an option.
Under Regulation B, can we have an application for a pre-qualification in the case of a refinancing so we know the property?
So a refinance, you already know the property. So I guess the way our teams always interpreted, always looked at it, whether we're talking about HMDA, Truth in Lending, TRID, throw whatever regulation, RESPA down on the table you want. There's no such thing as a pre-qualification for anything outside of a purchase transaction.
For HMDA, we have a HELOC used for a down payment, to purchase a local movie theater and some business operating expenses. Would this HELOC be HMDA reportable?
So a home equity line of credit to purchase a movie theater. I'm having a hard time with this because a home equity line of credit is a consumer purpose loan, consumer disclosures, and you're doing a commercial loan. Now, you're buying a movie theater, I assume, for it to be a movie theater. I'm going to read between the lines here a little bit. So I wouldn't use the home equity line of credit product to do this. That said, lines of credit, consumer or commercial, secured by a primary dwelling can be HMDA reportable. Now, if this is business purpose, hey, it would be business purpose equity. We're not buying a dwelling, improving a dwelling, refinancing a dwelling. Therefore, from a business purpose standpoint, it wouldn't be reportable under HMDA. But if somehow you were skewing this towards consumer, and I'm really struggling with how to connect those dots here, then I suppose it could be. But this thing doesn't walk and talk like a HMDA reportable loan on a consumer side. It sounds like a commercial loan that somebody's doing on a consumer paper, which they shouldn't be doing. That doesn't make sense to me. And then I want to fast forward to 1071, that if it's not HMDA, we fast forward down the road because it's business purpose home equity, therefore not HMDA, it's going to be 1071 if you're a 1071 reporter, and then you would have to collect and report under that regulation. So again, we're having a little extra fun with something that's coming down the road, but lots of moving parts with that potentially.
Under Regulation B, can you explain differences in when we need joint intent documentation with a co-borrower versus a co-signer or guarantor?
Okay, so anytime there's more than one applicant, you need to have intent to apply documentation. And the cosigner has some wording in it in Reg B that said they use this word contemporaneously, which is not plain English, but it means they walked in arm in arm at the same time. So let's just say I'm sitting at home and I know my credit's not very good. And so I know if I'm going to go to the bank, I need to come in arm in arm with a cosigner. So Diane and I walk into the bank. Diane's going to be my cosigner. We're applying at the same time. She's going to be a cosigner. She's going to meet that definition. And so it's at the same time. We'll go back to that contemporaneously. What intent to apply says is if it's at the same time, then yes, intent to apply is triggered. If you say, Jared, no, let me change that. If I come in and apply on my own, and you say, Jared, sorry, we can't do this, and I say, well, how could we get this done? Well, if you bought in a qualified co-applicant, co-borrower, guarantor, co-signer, we might be able to take a look at it. If it's a required co-signer, after the applicant is applied, they go get them, bring them back. Remember, you can't name them. All you can say is if you brought in a qualified co-applicant, co-borrower, co-signer, guarantor, that sort of thing, then technically it wouldn't apply in that situation because it's a required co-applicant, co-borrower, guarantor, not by name, and therefore intent to apply wouldn't be triggered. That said, that's a hard thing to remember, and that's the if, ands, and buts that make the compliance with intent to apply a little bit tricky. My recommendation is you just get it every time. The one place where maybe it makes sense not to is officers, directors, shareholders, partners that are going to guarantee, where you don't often see those people. Technically, intent to apply wouldn't be required in those instances. Again, officers, directors, shareholders, partners. Hey, you could make them guarantee it. Can't make them sign the note, but the guarantee you could. Then I wouldn't get intent to apply. But outside of that, it's just a lot easier to get it across the board.
Are there any tools or resources you could recommend for anticipating banking requests from non-US citizens?
Okay, so there's a couple things out there. The big one being, late last year, the CFPB put out a warning shot on blanket policies of choosing not to lend to non-U.S. citizens. I would take a look at the guidance there. And the other one would be the limited English proficiency information that's out on the CFPB's website. So those would be the two resources off the top of my head. Again, the non-U.S. citizens blanket policies of not lending to them, and then the limited English proficiency. There's several things out there the CFPB has documented in that area. So I'd start there.
Back to flood insurance. We currently have a loan secured by a condo located in a special flood hazard area that had such heavy hurricane damage it is now considered uninhabitable. The company with the original flood policy will not even renew it. Does the regulation give any kind of out to the flood insurance requirement in cases such as this, or must we try to force place flood insurance?
Yeah, so this happens from time to time, especially when you have natural disasters, that when you made the loan, you had insurance in place and it paid out. But a lot of flood insurance, once it pays out, they're done. It's a one-time deal. Sometimes you get a more than one-time deal, but a lot of them are one-time and done. And so you still have a loan. You got reimbursed for the insurance, but maybe the structures, maybe you didn't pay for the entire structure or something like that. And so you're still stuck with it being your collateral, but it's an uninsurable structure at this point. And therefore, as long as that story's there and you write, how you got to where you're at, you should be fine. But that does happen from time to time.
Back to HMDA, we have a request to use the applicant's newly constructed home as collateral to pay off their builder. The land is already deeded to the consumers. The builder does not have a lien. Is the HMDA purpose a purchase, refinance, or other?
Sounds to me like they already own it. They already built it. So we're not purchasing. We're not refinancing because there was no debt on it. We're not improving. It's already built, been improved. We are doing other consumer home equity.
Will you touch on the differences between a renewal, keeping the loan number the same, and a refinancing?
I'll start with this. Renewals are a thing, but they are, but they aren't. They're referenced in some of the regulations. And the use of the term renewal, when we coach financial institutions from a compliance perspective, the term renewal, I try to say, let's just stop using it because it's going to get you in trouble. I want you to imagine in front of you, there's two buckets. Hey, bucket number one, we're going to call it a refinance. The refinance bucket works like this. You have loan A, okay, and you're going to be making new loan B. We're going to take loan A and we're going to tear it up, satisfy and replace it with a new loan B. That's a refinance. In that scenario, we trigger new disclosures. It's a whole new, compliance across the board. If I have loan A and I'm not going to tear it up, I'm simply going to attach something to it. We're going to call that a modification. You might call it a renewal, but I'm going to get rid of the word renewal. We're going to call this a modification. Okay. That doesn't trigger new everything. Now, that said, there are compliance requirements that are triggered by modifications. Intent to apply. 1071, when it comes to the table, some modifications are in, some modifications are out. Hey, different than a HMDA. HMDA doesn't care about modifications. Truth in lending, it cares about satisfy and replace. And then it's got some provisions that say, well, if this, but that, then that, and we're not going to get into all that today. So there are some modification things that trigger other regulatory requirements. Refinances trigger the whole 9 yards. And so I'll go back to, give me the end of that question again. I forgot to write that down. The very end, was there any
just touching on the differences?
Okay, talk about trouble. You would always be better off. I don't want to say always. In most cases, you're going to be better off doing the satisfy and replace, new disclosures across the board. There are times and places for modifications. Big one would be ability to repay. You've got a borrower that somehow has been paying you back, but if you put them through the ability to repay cycle, that they wouldn't look good on paper. And so in order to avoid what appears to be ability to repay issues that might present themselves, you simply modify and extend the existing loan, not triggering the ATR requirements. And so there's times and places for things like that. But I would get rid of the term renewal, modification or refinance, one or the other, pick the bucket. The renewal is just going to get you in trouble. Now, I forgot to mention this. Somewhere in there you mentioned, we keep the same loan number. We don't keep the same. It doesn't matter. Loan number doesn't trigger anything. It's did I satisfy and replace, triggering new everything, or am I modifying? Hey, and if you want to keep the same loan number, it doesn't matter. Okay, where it's just we're keeping the existing law obligation and attaching something to it, triggering some things that's applicable regulation by regulation.
Under HMDA, on an investment property sold to the secondary market, are these loans considered for business purpose?
Okay, so it depends on your definition of investment purpose. Just because it's investment purpose doesn't mean it's commercial purpose. I could be buying a rental property so my son or daughter can live in it while they go to college. That's consumer purpose. If I'm buying rental properties to have rental income on the side, that would be business purpose, in my opinion. You might call both of those scenarios investment properties, but one's consumer and one's not. So you can't just say investment is all going to be commercial.
Would you touch on the differences between a credit inquiry and an application?
Okay, so this is a Reg B thing. So do I have an application or somebody just inquiring about my stuff, my products, my services, my process? Why is it important? Because applications trigger regulatory requirements like intent to apply, collecting government monitoring information, the appraisal disclosure, and we can go on and on and on, right? Inquiries, they don't trigger anything. Now, that said, we can't illegally discriminate in the inquiry stage. So if somebody just comes in and wants to know about, tell me about your products, tell me about your services, tell me how it works. Okay, what are interest rates? Okay, what type of loan terms do you offer? Tell me about the things like that, and you keep it in the inquiry stage. You haven't triggered anything yet. But that transition from inquiry to application can happen really quickly, and you not even know it. So let's say I stop and I'm asking Diane tell me about the products, the services, the terms, just tell me, whatever you think I might need to know. But in the process of our conversation, let's say, Diane, I filed bankruptcy about a month and a half ago. And then Diane says, well, we have a policy at our bank that if you filed bankruptcy in the last year, we can't make you a loan. Well, she just turned my inquiring about, products and services. And then I gave her information, and then she in turn provided me feedback on, hey, this ain't going to fly. She just turned that inquiry into an application. Hey, now, application like Fannie Mae 1003? No, like adverse action notice. She has to send me an adverse action notice now. So, and you've probably all been there. You've had the applicant, not the applicant, the customer, the client that comes in and says, oh, I don't want to apply. I'm just looking for information. And by the time you're done talking with them, you've got an application, not based on what they asked for, but based on what they gave you as far as information and how you responded to them. That's the important part. So it's all about how you respond. If you keep encouraging them to move forward and you haven't got to the application place yet, you're probably still in the inquiry. So I'm going to use that scenario. I present Diane with my bankruptcy a month and a half ago. And Diane says, well, we've got policies on it, but you know what? You never know. Would you like to apply? No, not ready yet. Well, then that's still an inquiry. But if she says no, that changes the game. Again, that's another one where we have a 2-hour webinar where we get into the details and scenarios on that. If you want more, I'd love to share that with you. Come check out our training.
Would you touch on potential concerns with not using a paper or electronic application form for commercial loans and instead choosing to input data, sometimes verbal, into a personal financial statement?
Okay, so I'm going to start with the last part. Personal financial statements, be very, very careful. They're not applications, and they will generally get you in trouble with Reg B's intent to apply requirements. Now, a lot of information from a personal financial statement is necessary in doing underwriting and collecting data and that sort of stuff. I'm going to go back to the first part of the question. I'm going to bet that most people here today, not all, but a good majority, don't have a paper application for commercial loans. And you're probably trying to, if you've started any sort of 1071 implementation thought process, you've probably entertained the idea of, gosh, are we going to have to go there? I think in some part, everybody's going to. There's at a minimum a 2-page demographic information request document that has to be separate from all the other application information that you're going to have a form for. And it's going to be a piece of paper in certain circumstances. Could be electronic, but you're going to want to have the paper too. So at a minimum, you're going to have that. Then there's the rest of the application information. Some of it has to come directly from the applicant. Some of it you can gather from information that you've collected from the applicant as far as the data that's got to be reported. But there is a certain amount that I have to say, Diane, I need this. And we can have a verbal conversation, and that's fine. But I'm going to bet that you're going to want to go to some sort of application form, because what the reg says is you can rely on statements, written or verbal, provided by Diane. Well, you also have to show evidence of compliance. And so I think there's going to be some sort of electronic paper trail that you're going to put in place, plus the 2-page demographic form, and then maybe even a third thing that's like a proof sheet that gathers everything. But again, we still have separate documents that have to be kept in a separate place. Again, we get into all that in the 1071 training if you're not familiar with it, but there's going to be a lot to think through there. In fact, just last month, or maybe it was 2 months ago, we spent an hour and a half on this topic. And I know we still don't have all the answers, but we know that we're trending in that paper application / electronic application direction.
On TRID, when we're preparing the closing disclosure for a second mortgage, is homeowners insurance required to be disclosed as paid outside of closing? And if so, would this be in section H for other?
Okay, so let's start with the last part. It'll never be in section H ever. It's only ever going to be in the prepaids if it's going to be there at all. If we're doing simultaneous subordinate financing, a first and second at the same time, my assumption is you're going to have any homeowner's insurance that's going to be coming due on the first, and therefore it wouldn't need to be on the second. Let's set that one aside. Let's say you're just doing a second mortgage. Okay, it's a home equity loan. Here's how it works. Whether or not homeowner's insurance has to be included on the documents, loan estimate or closing disclosure, is going to be determined on whether or not it's going to be due and payable between the application date and the first payment due date. If it's due and payable within that window, then you'll need to disclose it. If it's not due and payable within that window, you don't put anything on the disclosure, and it's not paid outside closing. Now, when we get to the closing disclosure, if they pay for it before the closing table, but it's due within that window, it'll be paid. It'll be in the borrower paid, but not the closing column. Okay, outside of closing, if you will.
Back to 1071. Can we just collect the data we're required to collect under the 1071 rule for all commercial applicants rather than just small businesses?
When it comes to, and I know this is going to be a term some of you aren't familiar with, but there's 2 different forms of data that you're required to collect, and you have to collect both. There's non-restricted data, and then there's restricted data. Restricted data is the demographic information. We'll just leave it at that for now. When it comes to the non-restricted data, you can collect that across the board. There's no prohibition on that. So you can collect on every commercial loan that you have. That's fine, or commercial application. But when it comes to the restricted data, the demographic information, that's information you're not legally allowed to have outside of those applications subject to 1071. Why? Because it's prohibited basis information. Go back to baseline ECOA prohibited basis characteristics, the protected characteristics, if you will. So you cannot over the or across the board collect restricted data on every commercial application. You're only allowed to have that data for those applications subject to 1071. And then the rule goes another step and says, even now that you have it, you can't use it. So you can collect it, but then you got to go and hide it. And I'll just kind of leave it at that for now. There's a lot more to it.
For HMDA, would a loan or line with interest-only payments also be reported as having a balloon payment?
Yes, because interest only would not fully amortize. There's going to be something left at the end. Therefore, it would have some sort of balloon left over. So yes, for HMDA.
Under the 1071 rule, I understand that some information will need to be stored separately. Do you have any take on how institutions will accomplish this?
I think the large majority of the financial institutions will accomplish this electronically. So imagine, if you will, that 2-page restricted data collection form. You're going to collect that. You're going to scan it into your system, and it's going to go under lock and key in an electronic file. Now, it might be within, so if Diane's the customer, it's going to be in her loan file under that loan transaction, but it's going to be saved such that not everybody has access to it. Okay. Those that can see the loan file, fine, but there'll be people that can see the loan file that still can't see that restricted data. So for those of you that are going to have an electronic storage format, I think you're very soon going to see this come to fruition, and it's not going to be as hard as it maybe seems on the surface. I think it's going to be harder for those of you that don't store things electronically. Those of you that do paper, it can't be in the same paper file for the most part. I know there's some wording in the section by section, or not by the section, in the small entity guide that makes it appear like you might be able to keep it all in a nice, neat paper file, but that assumes that you have nobody subject to the firewall. If you have anybody subject to the firewall and they go grab the file, you have a problem. So now you need to have a separate paper file for the demographic information, the restricted data, than for the other information. And that's where it gets a bit complicated. So electronic storage is going to simplify this greatly. Those of you that aren't storing electronically, it's going to be a little bit tougher hurdle to get over.
For HMDA, our HELOCs could result in negative amortization if the rates go higher, so we mark that feature. If it's not fully amortizing because of our payment structure, would we also mark other non-amortizing features?
Okay, I'm struggling with why rates going higher would make it negative amortization on its own, because if it's interest only, the interest only should keep up with the interest rate going up. But let's assume it's not, and it's the last part of the question where there's some payment structure that causes it to be a negative amortization loan. Then yes, you would have, from a HMDA standpoint, there is that data field for other non-amortizing features. You would have to select and report as such that yes, it does in fact have those.
For Reg B purposes, how long should residential real estate loan pre-qualification stay in our pipeline before we are out of compliance? Or does it become an application under Reg B since an application form is collected?
So pre-qualifications for Reg B are very likely applications. They're either pre-qualification apps or inquiries. And if they're laying in your pipeline, I'm going to bet that they're pre-qualification applications. Okay. So when it comes to your pipeline, it's not a regulatory thing. I mean, some banks are 30 days, some banks are 90. I've seen some 6 months. Some we've been in that have no rules or rhyme or reason to how long they keep things. And we teach them that they need to come up with something and try to be consistent, because things shouldn't just lay in the pipeline forever. It becomes even more important if we talk about a pre-approval program or stuff that lays in your pipeline that does have property address. That makes it even a bigger deal. But if we're just talking about pre-qualifications, no property address, just get it cleaned out, every 30 or 60, maybe 6 months. But they are applications for Reg B, but they shouldn't be HMDA because there's no properties yet if they're true pre-quals. Hey, if we have addresses in there, that's a whole different story. I tell you what, Diane, holy cow, I just looked down at the clock. We are at 1:58. I got a couple minutes left, and I've got a few things before everybody goes today. So let me do this. I don't mean to cut you off. Thank you. You did a fantastic job. Boy, time flies. I want to share my screen once again here with everybody. So give me just a moment. Here we go. And first off, thank you for all the questions today. We tried to take a mix of things that came in pre-submitted. Thank you for taking time to do that, as well as live. And so some of those you saw me taking down notes, they were live along the way. The goal was to get to as many as we could in the 1 hour time frame. We got to be close to a record. That felt like about almost 50 or 60. I'm not sure where it landed. I'll check with Diane later on, but we got to several of them. Here's the deal, folks. This is the lending version. We're going to do the deposit version in April. You can already go get registered for that. In fact, my teammate Kyla Likely in the chat room, in the chat button, has put down a link where you can go click on that and get your team registered for the deposit Q&A. That'll be followed up in the third quarter with a BSA AML Q&A, and then we do a little bit different type of forum the fourth quarter of every year. It's a look back and what lies ahead. It's kind of a big giant checklist to make sure that you and your team stayed on top of things, and if something fell through the cracks, we get it back on your radar, and then we give you kind of a glimpse of what's to come around the end of the year and into the new year. So we do these quarterly. Get your teams registered. We'd love to have you at the next one. With that, we want to keep this to an hour. Want to make sure that you can get to the appointments that you've set beyond the time frames of today's program. And so I want to thank you on behalf of our team for stopping by and listening to some Q&A here today. What we're going to do now is first let you know there's a survey that popped up behind the screens. If you take a minute, it's just a short thing, probably less than 5 questions. I don't even know anymore, but it'll take you less than a minute. We'd love to get a little feedback today on how we did. Aside from that, again, thank you. We're going to let you get back to what you do so well, and that's serving your customers. Thanks again.